Hi, this is Aaron Fernstrom, Director of the Mayo Center for Asset Management at the Darden School of Business. We're here with Ayako Yasuda at the 2020 Academic and Practitioner Symposium on Mutual Funds and ETFs. Thank you so much for joining us.
Sure.
So I wonder if you would share with us some trends that you're noticing and that are of interest to you in venture capital and private equity.
Sure. There are a lot going on in the industry right now, but the three trends that I'm keenly interested are as follows. One, there is more private equity in tech industry. Now, venture capital-backed companies used to exit either by going public or being sold to strategic buyers. And more we see private equity buying those VC-backed companies. That's becoming the third exit for VC. And that's an interesting trend. There are even some private equity funds that are dedicated only to software companies. So understanding why this is happening is a very important question. There may be something about leverage becoming more available to tech. There may be some companies' preference to stay private longer. So these are interesting questions that we should be looking at. The second trend that I'm very interested in is the call for greater diversity in private equity, especially in venture capital. There's a recent a paper that looks at the gender of the venture capitalists and the gender of the entrepreneurs they back. And what they find is that the male angel investors disproportionately tilt toward male entrepreneurs, and female angel investors likewise tilt disproportionately more towards female entrepreneurs, even though that say for the male angels, that the male entrepreneurs they back don't outperform. If anything, they underperform the female entrepreneurs they back. So female angels act in the same way, but because there are a lot more male angel investors, this ends up being effectively a bias against female entrepreneurs. So actually increasing gender diversity for venture capitalists could have a pretty positive impact on female entrepreneurs. And I think that's a very exciting trend that's going on. And the third trend that I'm very interested in is the rise of impact funds.
Sure. And you do a lot of work in that area.
I do.
I wonder if you'd share with us some reflections of your work and this new measure that you've developed and some details about it.
So we have a research paper that's forthcoming in the Journal of Financial Economics where we look at the investors' investment decisions in these impact funds. And what we find is that, by the way, impact funds are venture capital funds that pursue both financial returns as well as either social or environmental positive impact. And what we find is that investors in impact funds are willing to accept lower financial returns in exchange for the positive impact, about 2 to 3% IRR per year. And this is an important result because this refutes this notion that investors are interested in sustainability only when there is no sacrifice of financial returns.
Right.
Instead, what we are finding is that they value this positive impact on the society or environment in and of itself, and they are not just maximizing financial returns. As for measuring the impact, I think it's very important to distinguish what kind of impact concept we are after. And there are two broad concepts of impact. One that we take in our paper is impact is about positive externality. So whether you're generating good jobs or you're generating mitigating climate, those are externality that the funds generate, and you're not really benefiting from it directly as investors. You're only getting the financial returns, but you're providing this benefit to the overall society and the planet. If you are after that kind of impact, then the metric that you would use would be very different from the second impact, a concept that people often use without really defining it clearly, and that's called materiality. Materiality is about whether the portfolio you hold are liable to some, let's say, environmental risk down the road. And it's more of a defensive measure, and you want to make sure that you are not subject to this, let's say, a stranded asset risk. So there are a lot of interest, more from mainstream investors, to measure this materiality risk. This is a very important concept, but very different from externality concept. So when we are talking about measuring impact, I think it's very important that we clarify and build a vocabulary and a language around it so that we are providing the metric that a given clientele, given investor wants.
Ayako Yasuda from the 2020 Academic and Practitioner Symposium. Thank you so much for joining us.
Thank you.